we've looked at two different approaches to approaching the market in a rigorous way. We looked at a way to trade the squeeze based on a set of decision rules, and we looked at a trend following system based on the conjunction of price action within the bands and price action as painted by the indicator MFI, the money flow index. And when those two converged in a special set of circumstances, we looked at what the consequences of that were: buy signals on the upper side of the bands and a high position for the indicator, sell signals on the low side of the bands and a low position for the indicator. When you have those sets of circumstances together, you have a good opportunity in the market. We then combined chandelier trading stops with those systems to help us out when the inevitable happens, which is we get a bad trade from those systems. So we have two different approaches, and it's the combination of those approaches that is really so interesting, because it helps you get the trading system itself helps you with the wins versus losses. Remember, we talked about two dimensions of performance analysis, the number of wins versus the number of losses. Well, the trading system itself gives you entries that are going to be biased towards success. And then the stops, the chandelier stops, give you some discipline and help bias the ratio of the size of your wins to the size of your losses toward the winning side by truncating or keeping the losses relatively small while allowing the winning trades to run. What we're going to look at now is a similar approach, but rather than going with strength or going with weakness, we're going to try to anticipate strength or anticipate weakness. We call this a reversal system. What we're going to look for is a stock to come down, bounce, and go our way, or a stock to come up, fail, and then go our way. Either way, we're not biased one way or the other. We don't care whether we're going to take a long trade or a short trade. We just want the indications of where the opportunities are. Some of you are going to take a balanced approach. You're going to take both long and short trades. Some of you are only going to take long trades, and believe it or not, some of you are only going to take short trades. There are some people like that. Oh, you know, when I came into this business, shorting was still an evil kind of thing. I remember just coming in, the whole idea of shorting, if you think about it in a brokerage account, you do it in a special account. You don't even do it in your regular account. And I can't help but remember back in the 30s when America was in such trouble in the Great Depression. There was a Broadway musical. The lead line in one of the songs in the musical was, "Don't sell America short, sport." So anyway, we're biased in neither direction. We're just going to try to find reversal points, whether they're long points or short points. We're in the business now of picking tops and bottoms. Momentum lows versus price lows are an important part of this puzzle. If you think about a W bottom, what really happens in a W bottom? You come slicing down into the lows, very high momentum. You bounce, you come back, retest, and then you go. Well, we call this first side, the left side of the W, the momentum low. And we call the right side of the W the price low. It's because often on the right-hand side of the W, a new low is recorded in price, but it is not a new low in terms of momentum. So that's the concept here when we talk about a momentum low versus a price low. You have your primary event, which is where the biggest energy is, the strong drive, the big volume. You bounce, you come back, and you establish a secondary low, that low is the interesting low. Indicator confirmation is essential here, right? There's no way to understand these. There's no way to get a handle on these without indicator confirmation. Remember, our first tenet, there is nothing in and of itself about a tag of the lower band that is a buy signal, and there is nothing in and of itself about a tag of the upper band that is a sell signal. Only by comparing either a price pattern or comparing price action to indicator action can we come to trading decisions. So this is what our reversal system is going to look like. It's going to look very much like the logic that we employed for our trend following system, except we're going to invert it. And we're going to substitute intraday intensity for the money flow index. So we're going to run this with another indicator. I encourage you to play around with these indicators, to choose some of the other indicators and to substitute them in, see how the performance suits you. It can be a lot of fun, and it can be incredibly enlightening as to the way these parts and pieces interact. So when we're near the upper band, we want percent B to be greater than 0.8. When we're near the lower band, we want percent B to be less than 0.2. That's the same from the prior system, right? It's the same. But now we require indicator non-confirmation. So when we're near the upper band, we want 21-day intraday intensity percent to be less than 0. And when we're near the lower band, we want 21 intraday intensity percent to be greater than 0. So we want to be down at the lower band and up with the indicator. We want to be in the polar opposite position. And these trades are best when the divergence is big. Not just the indicator positive, but the indicator very positive. And that's reflected here in some suggested tweaks for the system. The first tweak is require greater extremes. Require that we be in the top 10% of the band or the bottom 10% of the band, or even require that we be outside the band, either to the upside or to the downside. You're going to reduce the number of trades that you come up with, but I think you'll find that the quality of the trades either remains as high or even gets higher. And then if we do that, I want to require stronger indicator non-confirmation. So if we got up into the top 10% of the band, then I want 21-day intraday intensity to be less than -10. Or if we get into the bottom 10% of the band, I want 21-day intraday intensity to be greater than 10. So I'm requiring that we be more oversold, that we be more overbought, and that the divergence be higher, the divergence be stronger. And I think that that's a way of improving the overall performance of the system. The other tweak that I think will work very well is to vary the intraday intensity periods. 21-day intraday intensity tends to be a little slow moving for some people. Some people need a more active system. Some people want something that's going to be quicker on the trigger, get in there. You can do that by shortening the intraday intensity periods, but don't get carried away. I mean, I don't want to hear about 5-day intraday intensity. I just don't think that's going to work. Oh, I think you can just start shortening them from 21, and maybe something like 10 is a lower limit. But I think you're going to find that 21 works pretty well for most circumstances. We've talked a little bit about this before, but I really want to hammer it home here, because in this reversal world, these are the keys to success: the sign of strength and the sign of weakness. Let's look let's define these items now so that we can actually go out and quantify them in the real world. So we're not guessing as to what's a sign of strength and what's a sign of weakness. For a sign of strength, you must have greater than average range. And if you want to compare the true range to the 10-day average true range, I think that's a terrific way to go. If you want to just compare the range to the 10-day average range, I think that's okay also. If you want to just do it visually, so that you just, visually assess the heights of the bars, I want the bar to be bigger than the bars that preceded it. Not marginally bigger, but bigger. Substantially bigger, so that you can really see it, and not something that you're going to want to quibble about. That's ingredient 1. Ingredient 2 is greater than average gain. In other words, look back at the recent trading history of the stock. If on average when the stock is up, it's up a point, then I want to be up like 2 points. If on average it's up 10 points, then I want to be up 20 points. I mean, I want to be experiencing a significant moment. I don't want, if it's up 2 points and this is up 2 1/4 points, that to me isn't significant. I want to really move up into a different type of trading activity. And I want greater than average volume. If we've been running at about 100% on our normalized volume, how about 200% or 250%? I want it to be distinguishable. In other words, no marginal cases here. A sign of strength requires that it really be a sign of strength. Now, these two conditions are really an or. You can have either one without the other and it'd still be okay. Think about it this way. You might be trading along and you open the day and you sell off real hard on the day, and then you rally really hard and close back on the high of the day. Well, you'll have the greater than average range, but that may not equate to a bigger than average gain. But the distance off of that low is a big distance. So that to me is equivalent to the greater than average gain. So you don't necessarily need to have both of them. For instance, you can have greater than average gain if it gaps open and then trades in a narrow range, because you include the gap in your mind. That's part of the range. So the conditions are not mutually required, but the thrust of the conditions needs to be there. We're looking for a sign of strength. And if we're looking for a sign of strength, this is what one looks like. This is H&R Block. What came down, we made a W bottom here. It's a really sloppy, evil W bottom, right? So we know that this really doesn't count, because look at all this extra volume on this side of the W. So now we have to consider whether this is a W or not, right? Because this clearly does not meet our criteria as a W. But does this meet our criteria as a W? Well, it certainly does. First of all, the low is above the lower band, the low is below the lower band. All right? And look at the volume on the breakout day. Huge volume. I assume that everybody will agree with me that this is greater than average range and greater than average gain. So it's off to the races. We've got a W bottom in. So all of our criteria have been met. We're looking for something to close the trap now, to set the trade. And this qualifies. It's a sign of strength. It's clearly evident. If it's not clearly evident, it probably isn't a sign of strength. Because the idea here is this is a psychological function. Right? And you want everybody to know this. You want everybody on the planet to see this sign of strength and know that the downtrend has been broken, that we're now in a new bullish environment, because it's all those other people knowing that are going to drive this advance. Right? But you're sitting here with prior knowledge. You got the idea that a W bottom is forming, and you're looking for it to complete. And what are we looking for it to complete with? A sign of strength. So if we have an SOS, a sign of strength, then we have an SOW, a sign of weakness, also known as a sow. And it's an appropriately sour kind of. Oh, jeez. Should we go once more? Greater than average range again is required, but this time it's greater than average loss on greater than average volume. Right? So it's the same formulation. We're looking for the same kind of deal. And here's a sign of weakness. Come up here, make a high, roll over, big down day. Look at the volume that's associated with it. I think it's clear in every aspect. Now, is this a sign of strength? No. It's too late. It might be a sign of exhaustion, but it's not a sign of strength. Signs of strength come near the beginnings of things. Signs of weakness come near the beginnings of things. So after a big decline, we're looking for signs of strength. After a big advance, we're looking for signs of weakness. This is not a sign of strength, even though it meets our criteria. It's greater than average gain, greater than average range, and greater than average volume. But it ain't the real thing. If it were down here, it would be. Now, that brings up an idea. Is this a sign of strength? No, the volume's not there. Is this a sign of strength? Yes, the volume's there. This type of idea, buying reversals like this, came to me right when I came into the business. This system, this approach had been in use for years before, but I learned it. One of the first things I learned in terms of market timing was this idea. You took a 21-day moving average, created 4% bands above it and below it. And then you took an AD oscillator, an oscillator made from advances minus declines. If you tag the lower band and the oscillator were positive, you got to buy. So it's comparing price action within bands to advanced decline information. Right? It was a very popular timing system at the time. It's, as you can see from this clip, it doesn't work very well these days. This is that same oscillator done using an MACD. And the way you do that is you set the first parameter on the MACD to 21 and the second parameter on the MACD to 100. And so what it does is it uses a 100-day average as the baseline and draws a 21-day average around the 100-day average. And it's the difference between those two averages that this is. Now you can see that from the straight AD line where we didn't get any signals, now we have a signal here where we come down, tag the lower band, and the indicator is positive. So it's possible to pull some of these older techniques up into the present by using some of the technology that we have right now. However, I do not recommend this as a market timing technique. Here is really where the rubber meets the road in terms of our approach. We come down and we make a primary low here. We bounce back and we make a secondary low. So the second low, where we come down and retest, makes a new low on an absolute basis. However, it doesn't make a new low on a relative basis. So if we remember our patterns from yesterday, this is a W2 absolutely because the second low goes lower, but it's a W4 on a relative basis. So that's our first piece of non-confirmation. Our second piece of non-confirmation is, I think, even more important. And you can see, you can see that non-confirmation here in terms of percent B. Here on the left-hand side of the W, we come down and tag the lower band. Percent B falls to 0. Here on the right-hand side, percent B stops at about 0.1. So new low in price, no new low in percent B. We'll have our divergence, and look, the divergence is confirmed by the indicator. The indicator was low here, looks like at about 30 on the MFI, accumulation distribution. And here, the indicator looks like it's about 40. But anyway, it's markedly higher on the retest and trending higher than it was on the first test. So we have a number of different pieces of information. We have a W2 versus a W4, a much weaker pattern, a much stronger pattern. We'll have percent B divergence. We have indicator divergence. And there you get, there's your sign of strength here the next day. What is it? 1, 2, 3, 4 days after the low, you get your sign of strength, and that's where you get into the trade, when the market confirms your opinion. Here again is the idea of one pattern being on an absolute level, another pattern on a relative level. And that's key. That's what Bollinger Bands help you define so well. Here we go. Here's a new high. Right? Come back, go back up, fail to reach the band, and then turn down. So there's our M. And now look down here. Here's our M. Right. So we actually made a new price high here by about a point, higher than our prior high. But look at our M here. So this is an M16, and this is an M12. One pattern on the absolute scale, another pattern on the relative scale. All right? So they're just completely different patterns. And then note the negativity here, strong tag, steady downtrend here. I myself probably would not have taken a trade in here. I would have waited a little bit, because at 25, this is still too strong for my own taste. It just, enough hasn't been wrung out. But time passes, and it gets wrung out. And now, any place in here, you know, you've got a well-defined top with all the breaks, indicator deterioration. You know, you can find any little cell in here, and away you go. Here's our trend reversal system written in Metastock code. Forget about the big block of code up here. We've seen all of that before. Just look at this little piece down here. Percent B less than 0.1 and intraday intensity greater than 0. All right? And this is the way I run my alerts on my system. This is actually a piece of code I use. Here's the short signal, percent B greater than 0.9, and intraday intensity less than 0. Same code examples for TradeStation. I don't think we need to really go through those. Now we need to implement a stop. And for the reversal systems, I'm going to use Wells-Wilder's Parabolic as a stop. We used Chuck LeBeau's Chandelier as a stop for our trend following systems, but these are interchangeable. You should pick whichever one works best for you. I only present them in this order by happenstance. My own personal choice is the chandelier, which is why I present it first, but I know a lot of people are very pleased with the parabolic stops, and they really like the way they work. They were developed by Wells Wilder, originally published in a book called New Concepts in Technical Trading Systems. It's still in print, still can be gotten. Published originally in 1970, something 76. Like 76. 76. The way we use them here is my own adaptation. I do not use it as a stop and reverse system. I use it as a stop that I start on the day that I enter the market. And if I get stopped out, I'm gone. I don't reverse. I just look for the next trade. The code for Metastock was programmed by another ex-Metastock employee, another guy out on his own these days, Robert Dedman. He did a wonderful job in programming it. It's what's called a DLL. It loads as it's needed into Metastock, allowing you to access its functions, and you'll see them in a moment. The key to parabolics is that they are steadily progressive. They keep on incrementing. There's one very odd circumstances where they'll remain unchanged for one period, but generally they keep on incrementing. They just go, 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 go. It's relentless. And a lot of people like that relentless quality of them. If the stock doesn't improve every day, the stop comes to get it. So they can increment even if no progress is made. That's a key piece of the parabolic approach. So here's how I use the parabolic logic that Wells Wilder introduced. And please do not confuse this with the stop and reverse system. I'm just taking the one piece of the logic and using it for my own stop. I start above the high or below the low on the entry day. I increment in the direction of the trade every day. That's automatic. The parabolic starts with small increments, and then the increments increase as time passes. That's why they call it a parabolic. It doesn't actually generate a parabolic curve, but often you'll see the stop will go like that. It'll start to turn up like that and accelerate. That some people interpret as a piece of a parabola or a piece of a curve, and that's where it gets its name. It's that the increment starts at a very small increment and then gets a little faster every day until it gets to the maximum increment. And a parabolic never backs off. You saw before where chandelier could back off a little tiny bit. If a new high wasn't made and the true range expanded, it could back off a little tiny bit. Parabolic never backs off. And I have a couple of charts here of what it looks like when it's a stop and reverse system. This is the traditional parabolic approach as published by Wells Wilder. And you can see it's very good at capturing long trends. And that's what it was designed to do. It captures these long trends, but in here, in this congestion phase, it gets whipsawed something terrible. I mean, these are all losing trades here. You exit a winner here. There's 1, 2, 3, 4 losing trades in a row inside here. This is why I have no interest in using this as a system. I'm just going to take this quality that allows the stop to track in a going market and use it as an exit technique for our own system. Again, look how nicely it takes out the big moves. Here's another big move, beautifully delineated and taken out. So when you get these impulse moves, the parabolic stop works almost perfectly. In this congestion range, it'll eat you alive. Again, Same illustration. I just picked another stock Amarada Hess. Chop, 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 chop. Ooh, take out a nice piece. Chop, 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 chop. Take out a nice piece. Take out a nice piece. Take out a nice piece. So when you get the big moves, parabolics work great, but in these choppy markets, they're ugly. Okay, here's how we modify the parabolic to suit our purposes. Start with the default parameters from Wells Wilder, which are 0.02 and 0.2. I'll explain those in a minute. But use his defaults for starters, no problem with that. Don't use it as a reversal system. Instead, start the parabolic under the hip or lop immediately prior to the entry day itself. What's a hip or a lop? Hips and lops. A hip is a high point and a lop is a low point. And that's all they are. There's nothing more to them. A hip is simply a high that is surrounded by two lower highs. A lop is simply a low that is surrounded by two higher lows. That's all there is to it. It's just a way of identifying a bar that has a higher high than its neighbors or a lower low than its neighbors. A hip and a lop. So, do not use as a reversal system. Instead, start the parabolic under the hip or the lop immediately prior to entry or on the entry day itself. So I'm giving you two choices, and that's because we'll come out of two different kinds of systems. If we come down to a real sharp turn and then roar right back, then I want you to start it underneath the lop. Or if we go straight up into the moon and then come straight back down, I want you to start it above the hip. Conversely, if we're trading like a squeeze setup and you just roll over into the trade, then start it above the entry day. So if there's a sharply definable hip or lop immediately prior to your entry, start it under there or over there. If you just enter the trade out of a fairly normal market, it's not a capitulation market, then start it on the entry day. Use the average true range to determine the start point. Do not reverse on exit. This is not a system. It's just using the technique for a stop. Parabolic stop tweaks for trend reversals. Adjust the constants to suit your trading style. Wells Wilder's parameters of 0.2 and 0.02 are fine to start. Let me explain what these parameters are. The 0.02 is the amount that the increment is going to increase by every day. It's the acceleration factor. And the 0.2 is the maximum acceleration. So it starts out slow and increases every day by 0.02 until it gets to 0.2. And that's where you get that accelerating curve from. I myself have found that for our purposes, for these types of systems, that an increment of 0.01 and a maximum step of 0.1 are really good values. It really slows the parabolic down. Otherwise, you're going to find this stop is going to be pulling you out of the trade too early for our purposes. So here's his parameters. You by all means start there and experiment. Here are the parameters that I have found to work real well, and they're the parameters I use in my examples. So here's an example of what it looks like. Here is our trend reversal system. We enter right here, and we get a nice trade up to here. We have an entry here, and we get stopped out here, and we have a final entry here. Note that if we had used the parabolic stops, the exit would have been much sooner. And in this case, the exit would have been at a much more attractive level than the actual exit. So this is what these stops are really good for. Here's a long trade gone bust. Here's where we normally would have exited the trade, but here's where our parabolic stop pulled us out of the trade.
And the normal exit is why?
The normal exit is, in this case, it's a chandelier.
This is a chandelier, but the one parabolic next to it?
Correct. These exits are triggered by a chandelier. You can see we came up and made this high, and when we've got 3 average true ranges below the high, we were out. All right? But I don't think you can afford to play that kind of game in a reversal mode. It just gives you too much room for error. Look at this over here. So when you're trying to pick lows, I think you need something more aggressive to get you out, and I think these parabolics do the job there. Note also that when you get the trade right, the parabolic stays with you. Here's our trend reversal system. We'll have an entry here, a short entry here, and notice both the chandelier and the parabolic take us out the next day. And that's because of this big excursion here that brings the chandelier right down on top. Remember, now it's hanging from the lowest low. So it got really yanked down. Here you get a different situation, though. Here's a short entry. Again, the trend following system is trying to find, the reversal system is trying to find a short entry in an uptrend, right? Now, check this out. This one, we enter here, and with the parabolic, we actually get away with our skin. We're flat. But with our chandelier, we end up with a small loss. And again, we got a long entry over here, and we are long still. So a couple of examples of where you try to enter in against an uptrend and how these stops save you from making big mistakes. You know, a lot of people will stick with a short for too long, and you know what they say about that? They say, "He who sells what isn't his'n must buy it back or go to prison." Okay, parabolic stop for the squeeze. Start with a half a position in the direction of the squeeze breakaway. Start a parabolic underneath or over the most recent lop or hip, probably the entry day. Reverse to a full position if the move turns out to be a head fake. Restart the modified parabolic under or over the most recent hip or lop. This is the one exception where we will reverse, right? Because our decision system told us to reverse. We're going to reverse the stop. We're not using the stop to reverse us. We're using the decision system to reverse. We said if we get a squeeze and we short it, if we scream back into the bands, we're going to reverse. Right? So that's our decision system is reversing us, and we are using the stop to keep us out of trouble. Use average true range to determine the distance from the hip or lop. And here you go. Here's a squeeze example with the parabolic. Here's our entry day. I went back to the hip and started the parabolic, and it carries us down right into here. We get stopped out on this day here. Now, you know, this is the problem that people have with stops on systems like this. They look at the rest of this move and say, gee, I wish I had gotten that too. Me, I look at this and say, my, how nice to have that. Really, if you're going to employ a disciplined approach like that, you're going to get situations where you get a little pullback rally that takes you out, and you walk away with a smaller profit than you might have gotten. It is the price you pay for your protection. It is the insurance premium, if you will. And then here's an example. Again, a squeeze, break down, turn back inside, start the parabolic running, and look at how nicely it works. This is because I'm using the slower acceleration factor and the slower maximum step. This is 0.1 and 0.01, right? If they were the regular parameters, we would have been gone over in here probably. But this is still long. We're still in this trade.